Hello, everyone, and welcome to our webinar today, which is on fixed interest savings, investing in a volatile market. And I'm sure a lot of you are here because, well, basically it has been such a strange year last year. There's lots of volatility in the marketplace. And what we're looking at here, we've had a number of clients coming to us and just sort of thinking, well, what options do I have when the market's like this? So the idea really of this webinar is to look at what are the different types of fixed rate investments available, what are the best options, what are the best rates available, and just to make you aware of what to look at when you're investigating these rates, and to give you an idea of really what the best rates that are available out there are currently available. So what we'll do is we'll start off by just giving you an introduction to Holborn Assets. So a little bit about who we are, what we do. So if you don't know, we are a family-owned business. We were established in 1998. So coming up 25 years this year. We won numerous industry awards, and we basically specialize in financial advice to people in the UK and expats. So we actually have offices all around the world. We've got offices in the UK, in Europe, in South Africa, the Middle East, and in Southeast Asia. So in total, we actually have 18 offices located in 13 different countries. And that allows us really to support and advise our clients wherever they move. We've got 500 supporting staff, and we have now around 25,000 clients all around the world. Importantly, we are registered and regulated to advise in the locations that we operate. All advisors, such as myself, are fully qualified to provide information and advice to our clients. In terms of my own experience, I've actually worked in financial services for over 23 years now. I work for Nationwide Building Society in the UK, HSBC, Wesleyan Assurance, and I've now worked offshore, giving it financial advice to expats, for now a little over 5 years. And I'm qualified in the UK. I've got my diploma level 4 qualification, which allows me to advise in the UK and also to advise offshore as well. So that's a little bit of a background to us. Now, let's start off by looking a little bit about what happened last year. So as you'd all know, it's been a bit of a volatile year, to say the least. And if we start off by looking at markets in the USA and what actually happened there. So the year ended with the Dow Jones 8.8% down, the S&P 500 19.4% down, the Nasdaq was down 33.1%. So these are huge figures in terms of volatility in the market. In terms of the winners and losers from last year, well, aerospace in the USA did very well. Defense did very well for obvious reasons. Healthcare and energy did well, again, for obvious reasons. The losers really were technology companies, and I'll come on to some of the results there. Automakers, so car makers, and real estate also did pretty bad last year in the USA. But what about the rest of the world? Well, it was still a terrible year. The Europe stocks 600 was down 12%. China's blue chip CSI 300 was down 22%. Germany's DAX was down 12.3%. So sort of similar figures, double digits, and really quite high losses on these indexes. If you're looking at Europe, the winners again were defense, fossil fuels. You've probably heard that Shell made 40 billion last year, which was £1,000 per second last year. And I know Centrica, the owners of British Gas, have just released their figures for this year and today, and they've made profits of 2.8 billion, which is vastly up on the year before. So obviously there are opportunities and there are people that are benefiting from the way the world is, but generally speaking, the markets aren't. And if you want to know the big winner in terms of markets out there, well, it's actually the FTSE 100, which actually ended the year almost 1% higher than at the start of the year. But when you look at the cost of inflation and the inflation rates, what we'll come on to, obviously that really isn't good enough for a lot of people. So if we look at some other statistics from last year, so if we're looking at individual shares, so these are big companies here. Apple shares fell 27%, Amazon shares halved, Facebook fell 65%. Tesla lost 2/3 of its value. And it's not just those companies. Microsoft lost 29%, PayPal 62%, Netflix 51%, Disney 44%. So the list goes on. And these are mainly tech companies, but actually tech companies form a lot of pension funds, a lot of investment funds. So people would have seen the knock-on effect of this in the stocks and shares investments that they currently hold. In fact, the global stock market, to get in context, actually posted the biggest annual drop since 2008. And as you're probably aware, in 2008 was the collapse of the banking sector. So when Lehman Brothers collapsed, which sent obviously shockwaves throughout the financial system, companies like Merrill Lynch, AIG, Freddie Mac, Fannie Mae, HBOS, Royal Bank of Scotland, Bradford and Bingley, Alliance Leicester, they all came within a whisker of collapsing. And this has been the worst year since then. And it just puts it into context. Probably of less sympathy to a lot of people listening, but the market sell actually wiped off 1.4 trillion from the world's 500 richest people. So Elon Musk, Jeff Bezos, Changpeng Zhao, and Mark Zuckerberg lost 392 billion between them. So these are huge, huge figures. And in terms of the global economy, it's projected to expand at a sluggish pace into 2023. The IMF, which is the International Monetary Fund, they predict that global growth will fall to 2.9% in 2023, and that inflation will remain high next year and the following year as well. So if we look a little bit about what's happening next year, because you've got to be very mindful of the fact that when we look at these sort of figures happening last year, we've got to be effectively mindful of inflation as well. So inflation in the UK was actually, it says 10.5%, it's actually 10.1% last year. Just dropped down to 10.1%, and EU are reporting double digits as well. So inflation is, if you don't know, is obviously the price of a basket of goods. So what it costs you effectively to do your weekly shop or to get your petrol. And the IMF predicts that inflation will remain high. And this is obviously going to be driven by oil, the price of oil, which everyone would notice, pandemic supply shortages, supply chain issues as well, and obviously the fall off from Brexit, really, which is still happening. There's been a rise in borrowing costs, which is depressing the housing market. So one way you deal with high inflation is to increase the cost of borrowing, so increase interest rates. So in the last year, or last 12 months, the Bank of England, talking specifically about England, have actually raised their rates 10 times. This month it went from 3.5% to 4%. So it's really increased a lot over the last year. And this is a way of trying to curb inflation. But what that does is it means that credit conditions start tightening. So people looking to borrow money, whether that's for a mortgage or just general loans, it becomes more difficult because interest rates are higher. The companies lending money now have to do new affordability checks. So a lot of people are having their mortgage offers withdrawn because the companies now no longer want to sort of lend them money. And the cost of living crisis, you would have heard about it as well. So businesses and industries are still recovering from COVID. There's high inflation, high cost of borrowing, higher fuel prices. This is all going to continue going into this year and next year as well. With regards to China as well, China is a sort of standout country, and it does have a big effect on the world's economy. And winter is aggravating China's COVID policy. So they're predicting that there's going to be a surge of cases in China over the next year. 3 waves of COVID is expected, and that will have a knock-on effect. And of course, the continuing situation in Ukraine, which is going to ensure that Europe's gas problems continue to exist into the next year. So these are all sort of what we're expecting to happen. And obviously, nobody knows for certain, but for sure, people want to start to protect against volatility. Now, don't get me wrong. Obviously, when you have a year like last year, there's clearly going to be opportunities because with any stocks and shares investments, the market drops and then it will pick back up. But at the moment, it is a little bit a case of how deep would a rabbit hole go, because it could go further. There's enough uncertainty out there to mean that the next 2 years, generally speaking, are expected to be volatile. So we just need to be aware of that moving forward. And that obviously gives people concerns about their income. So people that are relying on money coming in, people need to budget. So they have concerns about their income, their pensions and their investments, and they're really looking for peace of mind. And one way that you can have peace of mind for investments is to look at fixed rate options. And this gives you a known return. So it's not dependent on the factors of what's happening in the world. You're given a rate, you know what you're going to get, it helps you to budget. And as long as you're satisfying a number of conditions for yourself, then it is a good way to invest. And even if you do have stocks and shares and investments within that rely on the market as such, it's a good way of diversifying your portfolio. You know, any financial advisor will tell you if you've got investments, if you've got stocks and shares investments, a good way of balancing it is to look at fixed rate investments. And then that way, when the market is volatile, you have a known return as well. But you need to be very much aware of what type of fixed rates are out there. You need to be aware of inflation. So obviously, when you invest money, you need to make sure that it's at least keeping pace with inflation, because otherwise, technically, you're losing money. And especially if you're fixing or a rate for a long period of time, if you're not keeping pace with inflation at the end of your, let's say, 5 years, your money is worth less than what it was when you put it in, even though you've had a return. Security. So you need to be aware that the security of where you're investing. So you need to do your due diligence on where you're investing. The return, obviously, that's really important. You want to be getting the best return that you possibly can. So you need to be aware of what rates are available out there. And income. Some fixed rates will allow you to be paid an income, and that is a really good way of budgeting your finances moving forward. Now, there are three main types of fixed rate investments, which I'll come on to, and I'll talk you through these. It's important to note at this point as well that these rates change all the time. So I've tried to give you an indication really of the sort of rates you are looking at, but they do change. And as you can imagine, with interest rates constantly changing, so many different rates out there, they are constantly changing. So anybody that wants more of an idea of what the best rates are now, then obviously contact me. I can look at that for you. I can go through the different options for you. But I'm giving you an idea sort of on the next few slides. So the first type of fixed rate investment that you're probably going to be most familiar with is deposit fixed rates. So these are offered by most banks, building societies. They're very easy to set up. So you essentially would walk into your high street branch, you provide your ID, normally 2 forms of ID, you open up your account, which can normally be done very, very quickly. You get banks and building societies that will offer you loyalty rates if you've been there for a while. It's very simple to set up, which is the key for a lot of people, and why I would say the majority of people will have deposit fixed rates. And another reason that people like deposit fixed rates is that they're very, very safe. So they offer regulatory and government compensation. So I'm not sure how familiar you would be with this, but there's in the UK, the FSCS, which is a Financial Services Compensation Scheme. So if a bank or building society is authorised by the PRA, which is a Prudential Regulation Authority, then anybody investing with that bank or building society will actually have protection up to a limit of 85,000 sterling. So this is in the UK, 85,000 sterling per bank. So you can have a number of different banks, you can spread your money out, which a lot of people do, and that way you can have your money protected through this Financial Services Compensation Scheme. And what some people don't know as well is that you can actually you get a temporary compensation limit as well. So you can be compensated up to 1 million for 6 months period as well. And that is basically there to cover people who are maybe selling houses. You may then put it into your bank or building society. You then have that protection on the higher amount. So it does give you that nice bit of security. And when you're talking in Europe as well, European banks have a similar scheme, which is the European Deposit Guarantee Scheme, which is the DGS scheme, and that will give protection up to 100,000 euros per bank. So a similar type of scheme. And this makes it appealing for a lot of people looking to invest into fixed rates. So different terms and rates are given at the outset. So they won't change. You'll be given a rate, you'll be given a term. Normally it's between 1 and 5 years. They don't tend to go much longer than that. So it tends to be a slightly shorter term. And it's great for people budgeting, people looking for very low risk, people looking to budget. Deposit fixed rates, very easily accessible and very good at doing that. Now they're linked to the Bank of England, the bank rate of the relevant country. So where this is an issue, and I'll come on to it, it can be low, because if you look at interest rates in Europe over the last, up until really this year or last year, they've been incredibly low. So because of these deposits rates, fixed rates are linked to that Bank of England rate, quite often people are getting very, very low rates. And quite simply, they're not keeping pace with inflation. But not only that, is they're keeping nowhere near inflation. They really are very, very low. Now, when you're looking at these type of investments, liquidity risk is something to bear in mind. What this basically means is that when you're investing in a fixed rate, if you want to get your money out, quite often they will have penalties. And then penalties can be quite heavy. So normally they won't stop you getting the money out. Normally won't say you can't get it, but you get the money out, you lose the interest rate you were getting. So if you suddenly need that money and you want to get it out, then you've lost that rate that you were promised at the beginning. And they can have restrictions on how much you can take out as well. So they're really not good as an emergency fund. So as an emergency fund, and you need to get money out of fixed rate, you simply can't. You can't do it, and you need to be aware of that. Portability risk, which I put on there as well, is bear in mind as well, if you're moving countries, quite often the banks or building societies you're invested with will want you to close down that account when you move. Some people might go down the road of not mentioning it or not telling them, but more often than not, that you will be found out. And obviously what they will then get you to do is close down your fixed rate bond. So to be mindful of that as well. The biggest concern, however, with fixed rates, deposit fixed rates, is inflation risk, as I keep going on about, but it really is the key to this. So if it's linked to the Bank of England rate or the bank rate, the Bank of England rate, for example, was below 1% between 2009 to 2022, which is a lot of years, around 13 years, it's been incredibly low. It's only in the last year it started to go up. So when you're having that sort of rate, you are completely getting caught out with inflation over that period of time, meaning that there's a real loss on your money. If you're looking at the best fixed rates now, and I had a look before coming on today, you're looking at the best rates out there are going to be around 4.25 to 4.5%, but these are with quite heavy restrictions. Again, bearing in mind, if you're looking at inflation in the UK is 10.1%, it's still way below inflation, but certainly a lot higher than what it was a year ago, where you really were looking 1.5%. So it's not a bad time to look at fixing it, but you still need to be very, very much aware of the low rates that are being offered. It's essential, really, though, that you understand what is currently available, because there's a huge difference between options. So options, there's going to be a difference between providers, and there's going to be a difference between what country you're in. There's a difference on tax implications as well, because depending on where you are, could have tax implications on the type of fixed rate. So classic example would be that if, for example, you move to Spain and you've got ISAs in the UK, whether they're fixed rate or even if they're not fixed rate, your ISA will be taxable in Spain. It's not considered to be tax-free when you move to another country, and a lot of countries you move to. So you need to be aware of the tax situation, and there are huge differences between access as well. So again, with these sort of rates, they change all the time. If you want to look at more detail on what's available, then obviously I'm happy to help you individually and have a look and see what's what best rates are out there for you as well. Okay, so that's the one you're probably most familiar with. The next type we're going to talk about is government bonds. So probably less known for a lot of people. Basically, a government bond, the clues in the name, it's a bond issued by the government with a predetermined term and interest rate. It's not always fixed, but more often than not it is. They can be quite long. A lot of them are 10 years, they go up to 30 years, and in some cases even longer. So these tend to be longer than deposit rate bonds. But they're popular because they're considered to be relatively safe, and I'll come on to that. Why a government would issue a bond such as this is really to stimulate an economy. Could be that they're building major works, or they just need it for day-to-day funding. So they will effectively issue these bonds. They're considered to be secure. So this goes back to what I was mentioning about deposit bonds. They don't have the same financial services compensation scheme, but you are effectively borrowing from the government. So, lending to the government, and that obviously has security with it. But it is a bit of a grey area. So it depends on the government, really, and the government bond that you're looking at. So if you look at the USA does treasury bonds considered very safe. And for 10 years, they're currently offering 3.415 for a 10-year bond. However, if you're looking to earn more, you can get a government bond or the equivalent bond for 10 years through the Kenyan government. And I'm only using Kenya as an example. There's many more examples. And they are offering 14.34% for 10 years. So it's a huge difference. It's more than 10% difference between the two types of bond. But what it comes down to is risk versus reward, as it does with many things in finances. Obviously, would you be comfortable, lending to the Kenyan government? Is there more chance there of them maybe being an issue with them defaulting on payments, but you're going to get a higher return? So you be careful and be wary around this with regard to the security of bonds, because it's going to depend which ones you're looking at. They're more liquid. So unlike a deposit bonds, where obviously you can get your money out, so we've established that, but there's penalties. The way it works with a government bond is you do get a secondary market for selling. So people actually buy and sell government bonds, partly because there's such long terms on them. So it gives you improved liquidity. And quite simply, it would work if you take a government bond at a certain rate and interest rates rise, the price of your bond will fall in the secondary market because there'd be better rates out there than the rate you've got. On the flip side of that, if rates fall, the price of your bond will rise, so you can then sell it on. So it just gives you a way of trading, if you like, what you already have. And people like that about government bonds. There's that secondary market to trade in. What you need to be very wary of, and it's really the key to a lot of this presentation, is inflation risk. And I've got some figures for you, which I'm sort of blurt out, but obviously these sort of change at the time. But I just looked through 10-year government bonds at the time of writing, and this was about a week or so ago. But when you're looking at 10-year fixed rate bonds, so Australia currently has 3.49%, but they've got 7.8% inflation. Belgium have got 2.9% 10-year fixed with 10.2% inflation. France have got a 2.71% 10-year fixed, but they've got inflation at 5.9%. Germany, 2.25% 10-year fixed, and they've got 7.9% inflation. Greece, 4.26% fixed rate with 7.2% inflation. Italy, 4.21% for 10 years and 11.6% inflation. Not many more left. Netherlands, 2.57% for 10 years, 10% inflation. Portugal, 3.16% for 10 years with 9.6% inflation. Spain, 3.28% with 5.7% inflation. And UK, 3.19% for 10 years with 10.5% inflation. I wouldn't expect you to remember all that, but what it is telling you is that you can see a general trend there that all the rates you're being offered are well below inflation. They're normally around half or less than half of what inflation is. So again, you're relying on inflation falling over a period of time, or the bond that you hold will effectively devalue. Now, I mentioned on here government risk. So in order to get higher returns, as we touched on before, you might have to look maybe outside the bigger European countries to try to get that higher return. But obviously, you then got the higher risk of government collapse or default. So that's what's called government risk. And again, as I mentioned before, it's risk reward. And currency risk, you need to really be aware of as well, because obviously, if you're looking to invest in a certain currency, into a certain government bond, then it doesn't really matter. Well, it does matter, but the rate that you make as a return could be lost through the currency of that crashing. So you obviously need to change it back to the currency of where you're living, which in itself could wipe out any gain you make. So that's what's referred to as currency risk. Now, they're harder to get, government bonds. I mean, they're available through Treasury, through brokers, and even through ETFs as well. So they are available. There's ways, again, and I can certainly help if something that you are interested in. There's ways of getting hold of them. But what you really need to be aware of, and it's essential to understand the different options. So you need to be looking at, again, the risk of the government, the best rates, so the risk versus the reward of the government you're investing in, the best place to open the bonds, because there are places that will potentially open bonds for you, but they might have charges in themselves. Currency risk. So what are the options? Do they hedge your money so that when you invest in a certain currency, your money is hedged? Or are you going to be paid back in a different currency to what you invest? Inflation, as we've discussed again, and taxation. Again, you need to be aware of taxation at any types of investments, not just government bonds, not just deposit bonds, but any type of investment. So again, we can advise you on that as well to help you understand a little bit better about that. So the final one I'm going to go through, I would possibly the lesser known, would be corporate bonds. Now, corporate bonds are, again, I say relatively simple concept, but it's basically lending money to a company. So it's similar to a government bond, but to a company instead. And a company would do this because they may need to raise money for whatever it may be. And it's cheaper for them quite often than borrowing from a bank. So instead of borrowing from a bank to do what they need to do, they will raise the money through private investors. They give you a term and rate fixed at the outset, so you know exactly what you'll receive. You'll know the term, you'll have peace of mind. There's a huge variation in available terms. It's almost like a cross between a deposit and a government bond in that there are many different terms available. Where they are very appealing to people is they have some of the highest fixed rates available, and they will outpace inflation in potentially a lot of options that you look at. So lots of companies are out there, but you need to be aware of who you're dealing with. Similar to the government bond, if you're going to effectively lend a company money, you need to be aware of the risk of that company defaulting, because effectively you're providing your money, that company is taking your money. If that company goes bust, then you lose your money. So you need to make sure that there's security attached to the corporate bonds. So quite often that might be that they will secure your money on an asset, and that's really what you need to be looking at. So it's asset-backed corporate bonds, and doing your due diligence is essential. You need to be aware of the company itself, what they do, all that sort of thing. They can provide fixed income as well. So a lot of these companies will actually pay you a return. It can be on a monthly or a 6-monthly basis, and actually help with income that's needed. So whether that be pension income or investment income, it can do that as well. And they will often hedge currencies, because a lot of these companies are trying to raise money. They are aware that obviously people could lose money through currency risk. So a lot of them will offer a way of hedging your money. So if you invest in a certain currency, you're paid back in that currency, and you don't have to worry about the currency risk on it as well. You need to really understand and do the due diligence on this, and this is certainly one we can help with. You need to make sure you're dealing with somebody who's reputable, because there are some great opportunities out there, but you need to be aware of who you're dealing with. So effectively, it's who are the company you're dealing with. What is the security that they offer? So if it's asset backed and you're investing your money, how is that asset backed? What is their previous track record? You know, have they had bonds before? Have they paid out on these bonds? How many bonds have they had? What rates have they offered? What rates are they offering now? Is income available? What sort of term are you looking at? You need to be mindful, obviously, of the terms of any investment. Is it better to fix for a longer or shorter period of time? It depends really what your goals are. And what field is a company involved in as well? You know, because there's certain fields maybe you may not want to get involved in. But again, with corporate bonds, rates do change all the time. So again, we can look in more detail for you and give you an idea of what rates are available. But they can be anything, as I said before, between sort of 2-3% up to 15, 16, 17%. But again, you need to know who you're dealing with on this as well. So trying to summarize a little bit here, why are you looking to fix rates? The first and foremost is to protect against volatility. And that is the key to this. It's kind of a bit of unprecedented times when you look back at what's happened over the last year, and not even the last year, the last few years with COVID. It's just one of these years where it's like a perfect storm of a lot of things happening, and you don't really know what's next. You know, I was looking on the news this morning, and they were talking about the aliens. They had to rule out aliens when it was the spying balloons, and you just wouldn't rule anything out the way things are at the moment. But you certainly need to protect against volatility. Budgeting your finances is essential as well. You need to know what you've got coming out, what you've got coming in, and that way that you know you've got the minimum coming in that you need. It's a good way of diversifying your portfolio. So as mentioned, if you've got stocks and shares investments, if you've got mutual funds, it's a good way of diversifying your portfolio, providing you with lowering the risk and providing you with more security. It's a good way of fixing your income. Certainly with some incomes, you'll know what you've got coming in. And even if that's just covering your basic essentials, then at least you'll know what that amount is. You can protect yourself from inflation as well, depending on the type of fixed rate. But if you know what inflation is particularly high at the moment. It won't always be this high. It will come down. It looks like it may have peaked in a lot of places, but it's going to remain high, as we think, for the next few years. Certainly shorter term fixed rates, you need to be aware that you need to be trying to get the highest rate that you can. But for a lot of people, it's simply peace of mind. At the end of the day, you don't want to be waking up and worrying about what you've got coming in, and the fixed rate will provide you with that peace of mind, and increase your returns. If you're looking at a year like last year, most people with pension funds or investment funds would have seen quite substantial losses. If you're looking at a fixed rate, you wouldn't have done. You would have known what you would receive. So just finally then, if we just go what to consider, well, we've kind of covered this really. Very importantly is the security of any investment. The three types I've gone through, they've all got different levels of security. They've all got different things that you need to be aware of. The term, there's obviously so many different terms out there, and depending on what your goals are, what you're looking to do, the term is really important. You don't want to be fixing it for too short a period or too long a period. The rate, and that's the one everyone goes for. Look at the rate, but then if you've got a good rate, look at what the restrictions are on that. In order to get that rate, what are you having to sacrifice, if you like? The liquidity, and that may be the liquidity, it may be the answer to the rate I've just said there, is that how liquid is that money? If you've got your money there and you need it, can you get to it? What protection, and that's similar to security really, what protection are you getting where your money is? So that's it really with regards to what I've got to go through. I've sort of put there any questions and answers. From my point of view, really, if anyone wants more information on up-to-date rates, which I think a lot of people want to know, then obviously contact me directly. I can give them an idea of what is out there. I've just got a question coming through here from Sandra. Okay, Sandra says, moving to Spain, can you keep your fixed rate ISA with Barclays? Right, so this depends on the organization, and people might have heard a while ago, not just with fixed rates, but certainly with bank accounts. When you move abroad, a lot of the UK banks will want you to close your bank account, and it's the same with any investment types. So you can, unless a bank tells you have to close it down. But what you'd have to be aware of in that particular case, if it's an ISA, you're going to use your tax-free status there as well. What's that? Is it better to fix for a shorter or longer period at the moment? Well, that's going to depend on yourself. It depends on what your personal situation is. At the moment, you've got to be aware that in the short term, inflation is expected to remain high. Although it may be dropping a bit, it's expected to remain high. So any short-term fixed rate, you need to be looking at getting as good a rate as possible, or you're simply just fixing into a loss over the next couple of years. If you're looking longer term, then we'd expect inflation to sort of drop down to 3.5%, 3% after a period of time. But there's a lot of uncertainty out there at the moment, so it really does depend on what happens. But anyway, I hope that's answered a lot of your questions. I hope it's helped you a little bit. Please feel free to contact us anytime, and we'll be happy to go through your personal situation, or even if it's just a matter of finding out what rates are out there. I'm happy to answer any questions, whether it comes to the taxation as well. So yeah, please get in contact. But other than that, thank you very much for joining me, and I look forward to speaking to you. Take care.